You will not become a profitable trader if you do not master proper risk management. Risk management is one of the most important things you must know when it comes to trading. It's one of the most important factors that is required to become a profitable trader. So I want you to take out a pen and a paper right now and get ready to take down some notes, because I'm literally giving you the keys to becoming a successful trader. So when it comes to risk management, it's actually very simple, as it only boils down to 4 factors, right? Firstly, we have risk capital. Secondly, we have risk per trade. Thirdly, we have risk to reward ratio. And lastly, we have your maximum exposure. I'm going to take out some time right now to explain each one of them in depth for you guys. So firstly, let's look at risk capital first. What is risk capital? Risk capital is basically the amount of money you are comfortable losing. And if you lose it, it will not greatly affect your financial situation. So a lot of traders often ask me this question: how much money should I deposit into my account? And my answer is always the same. You should only deposit money you can afford to lose. So it's actually different from everyone. For me, it could be $100,000. For you, it could be $10,000. Or for John, it could be $100, right? Basically, you should only be depositing the amount of money that you are okay with losing. You must go in with this mindset that whatever money you deposit into your life account is gone, all right? It's gone. So I would advise you to ask yourself, how much of your total net worth would you be comfortable losing? Example, let's say that I'm comfortable with losing 10% of my net worth, and let's just say that my net worth is $10,000. So if I'm comfortable with losing 10% of $10,000, that means that I am comfortable with losing $1,000. So this is the amount of money that I'm okay with losing. So I'm gonna deposit $1,000 into my life account, not more. Alright, not more than $1,000. I can deposit $500, $600, whatever it is, but you cannot deposit more than the amount of money that you are okay with losing. Meaning that if you need this money to pay your rent this month, or for your daily expenses like food and traveling, transport, or is your emergency fund, do not deposit it into your life account. Alright, you need that money. You need that money to survive. So you should not be depositing that amount of money into your life account. And also, ladies and gentlemen, if you risk too much of your net worth, it actually messes up your psychology and it will cause you to actually lose money. Let's say that right now, same example, my net worth is $10,000. And instead of risking 10%, I risk maybe 60% of my net worth. So I deposited about $6,000 into my live trading account. See, 60% of my net worth is inside my live trading account right now. And today, I start taking a few trades in a row. And turns out I lose a few trades and I end up blowing that account. So now that I blew that account, guess what? 60% of my net worth is gone. I'm only left with 40% of my net worth. It's actually linked, because when you deposit a large amount of your net worth into your trading account, you have this mindset that now you must win every single trade, because your every last drop of money is on the line. So you will try to force trades. You will take trades even when there is no opportunity. And the worst thing you should do is to deposit every single bit of your money in your bank account into your trading account. I've made this exact same mistake in my first year. In my first year, I remember I was trading. I remember I had like maybe $500 or even $100 left in my bank account, and my goal was to like flip it to $10,000 or even $1,000 just to cover my daily expenses. It was the last drop of my money in my bank account. So the only $100 left in my bank account, I deposited into my live account, and I ended up losing that $100 because every single day I was just looking at the charts, looking for opportunities to trade. And even when there is no opportunity at all, I still take trades. And this causes me to take a lot of stupid trades without thinking through. A lot of stupid trades, as the saying goes, stupid trades equal to losing money, alright? So I ended up just losing that last $100. So I ended up broke for the entire month. So that is a lesson that I learned the hard way. So make sure you guys take this time out to really think, okay? Think about how much percentage of your net worth you want to put inside your trading account. How much percentage are you willing to lose, right? Are you comfortable with losing? It could be 5%, 10%, or even 1% of your total net worth. And then go ahead and put that capital into your life account. And that is what we call the risk capital. The risk capital. By the way, guys, if you find this boring right now, you should wake up, all right? Because this is very, very important. This is very, very fundamental for your trading success, all right? So right now, I'm just going to go through these concepts on risk management with you, and then later, I will go on to the charts and try to illustrate some examples. So if you are looking for charts, be patient and master these concepts first, and then later I will go through the charts with you guys. So the next thing I want to go through is your risk per trade. So what is risk per trade? Risk per trade is basically how much money are you willing to risk on each trade, every single trade. So this depends on whether you have a high risk tolerance or a low risk tolerance. So once again, it differs from everyone, right? For example, I might be a risky, a more adventurous guy, so I'll risk a higher percentage of my capital. And you might be a low risk kind of guy, like a play safe kind of guy who like to invest in those like safe dividend stocks. In that case, you should risk lesser money. So the general rule for risk per trade is to risk 1% to 2% of your total account on each trade. For me, I personally like to risk 0.5% on each trade, or sometimes even 1%. Right, so this is just how I like to trade, because this allows me to have much more room for error, meaning that I can lose a few trades in a row and I'll still not blow my account. So let me give you an example on this man named Andrew. You can see this derpy looking guy. This man is called Andrew. So Andrew risked 25% of his total account on each trade, right? Because he wants to get rich quick from trading fast. He wants to become a millionaire trader this month. So he's trying to flip his small account to become a few $1 million. Of course, to make money fast, you must risk a lot of money so they can get back a lot of money in return. That is exactly why this stupid ass man start risking 25%. So he started taking his first trade and he ended up losing it. And now he is down 25%. He lost 25% of his account. And then he started taking 3 more trades, okay? So he started taking 3 more trades and he lost all 3 of them. Minus 25%, minus 25%, and also another minus 25%. So he just lost 4 trades in a row, and every time he loses 25%. Which means he lost a total of 100% and he just blew his entire account just because he lost 4 trades in a row. Right now, when you are watching this, you probably think that Andrew is stupid and ignorant. He should have risked lesser. But when you're put in the same situation, you have done the same exact mistake. Just think about it, when you started trading, you also tried to risk a lot of money because you want to get rich quick fast, right? And you end up blowing that account over and over again. This is exactly why it is very, very important that you stick to the risk parameters of 1% to 2% per trade. So let's say right now, instead of risking 25%, you risk 1% per trade. If you risk 1% per trade, every time you lose 1%. So you can lose 100 trades in a row before you blow your entire account, right? You can lose 100 trades in a row. That is a lot of room for error. So like I said, once you have determined your risk per trade, then you can go on and calculate what is the correct lot size to use. So once you calculate the lot size, it depends on 2 factors. Number 1, your stop loss distance. And number 2 is your risk per trade, right? So based on these 2 factors, you're able to calculate your lot size and you already have your risk per trade, right? After you think that, okay, you know what, I want to risk 1% on each trade. Now, that is your risk per trade. So for your stop loss distance, it depends on the particular trade that you take, right? So let's say you take this trade today and your stop loss is 30 pips. Then yeah, the stop loss distance is 30 pips. So once you get these 2 factors, once you find out these 2 factors, that is when you can go and calculate your lot size using a position size calculator. So you can just go Google position size calculator and yeah, you can just come onto this page. So let me give you an example on a trade. Let's say that today I decided to trade Euro USD and I want to enter for a buy because I start seeing price creating a higher low right here. So I go down to the, let's say the 15-minute time frame to look for my entry. So once I went out to the 15-minute time frame and I decided that I want to enter for a buy here. So if I'm entering for a buy here, I'm going to be placing my stop loss below this higher low. And I'll place my take profit at the next key level, which is somewhere right around here. You can see in this example, this trade right here, this stop loss is 58.3 pips. So this is my stop loss distance, right? 58.3 pips. So I will go to my position size calculator that I have and just input the numbers. So you can see currency pair, choose Euro USD because we are trading Euro USD. And then the account currency, it depends on your trading account, what currency it is. So for me, USD. So for the account size, I will put $10,000. So let's say that I'm Andrew and I'm trading with 10K, all right? I'm trading 10K. And the risk ratio is how much money are you risking per trade, right? If you want, you can put money, or if you want, you can even put risk percentage. I prefer to put risk percentage. So I'll put 1%. I want to risk 1% on each trade. And my stop loss, remember the trade that I just took, the stop loss is 58 pips. So I'll put 58 pips. So once I place the calculate button, it literally does all the calculation for you, right? You will see that, okay, the sizing you should be using is 0.17. So right now, this is the correct lot size that you should be using. You should not be using a lot size that is bigger than this if you are following your risk management plan. So go on to your MetaTrader 4 and before you enter for the trade, go and change the lot size to 0.17 and then enter for a buy. Let me repeat that. You calculate your lot size first and then you enter for the trade. It's not the other way around. A lot of beginner traders, they enter for the trade first by using a stupidly high lot size, and then they end up realizing that that's a huge mistake. So make sure you calculate your lot size first before you do anything, and then you enter for the trade. So let me give you another example. Let's say that right now I saw that price is at this support level, and once again, I want to enter for a buy right here. So I enter for a buy right here, and then I want to take profit as somewhere right around here. And this time, I'll place my stop loss below this support level. So in this case, my stop loss is 15.7 pips. So I can just put that down right here. My stop loss distance is 15.7 pips. And how much is my risk per trade? My risk per trade, how much money am I risking per trade? So my risk per trade could be maybe I'm the risk 1% of my account on each trade. So 1% of $10,000 would be $1,000. So I'm risking $1,000 on each trade with a stop loss of 15.7 pips. Now that I get these two factors, I can go on to calculate my lot size. And how do I do that? Go on to the position size calculator once again. So in this case, I'm trading GP USD. So maybe find where's GBP USD? Right here. And now I'll put account size, same thing, I'm trading with 10K in my account and I'm risking 1% of 10K, which is $1,000. And this time around, what's the stop loss distance? Let me go check again. Is 15.7 pips, right? So 15.7 pips, I'll just round it up, put 16 pips, okay? 16 pips. And press the calculate button and you can see it does the calculation for you, as simple as that. 0.63 lots. You should be using 0.63 lots. So now go on to MetaTrader 4 and change it to 0.63 lots. That is how you can calculate the correct lot size that you should be using. So stop asking me what lot size should you be using, because it really depends on these two factors, your stop loss distance and your risk per trade. And your risk per trade depends on your risk tolerance. Now the third factor I want to discuss is your risk to reward ratio. So what is your risk to reward ratio? Your risk to reward ratio measures how much your potential reward or return is for every dollar that you risk. So let's look at this diagram right here to further understand risk to reward ratio and the importance of having a solid risk to reward. So you can see in this example, if your risk to reward is 0.5, meaning that you are risking 1% to make 0.5%, you are risking $1 to make $0.5. You will need a total of 70% of winning trades to cover the expenses of your losing trades. This means you need to win 70% of your trades, 7 out of 10 trades, just to break even. Okay, just to break even. Now, that is a very, very high win rate. And I would say that that is a very, very hard win rate to achieve. I can honestly tell you that professional traders, they have a win rate of about 50% or sometimes even 40%, right? And to get 70% win rate, you are saying that you are better than most professional traders. So I wouldn't say it's impossible, but I would say it's very hard to achieve. Now, next, your risk to reward. Let's say that you are taking a trade and you are risking 1% just to make back in return 1%. So you're risking $1 to make $1. So in this case, you need a total of 50% win rate. So you have to win 5 out of 10 trades. And like I said, this is the win rate of professional traders. And once again, it's pretty hard to achieve. So why not make your life easier and adjust your risk to reward ratio rather than win rate, which is something that is very, very hard to adjust. Now, this is exactly why I trade with a minimum risk to reward ratio of 1:2. If you are trading with a 1:2 risk to reward ratio, that means that you need a total of 35% win rate just to break even. So out of 10 trades, you only need to win 3 or 4 trades just to break even. And I can honestly tell you that is much more possible. That is much more realistic for us, for you retail traders. So I would advise you to stick to a risk to reward ratio of at least 1:2. And if it's less than 1:2, do not take that trade. Okay, the higher the better. And I would kind of advise you to aim for 1:3. So how you figure out your risk to reward is to set your stop loss and take profit first. Put it, adjust the tool and set your stop loss and take profit first, and then calculate your risk to reward ratio. And then you can assess your trade outcome and make better trading decisions for the next trade. So let me show you some examples on the charts. So using back this same example on GBPUSD, let's say that I enter for a buy somewhere right around here in the middle. Okay, enter for a buy here. And I'll place my stop loss below this support level, and I'll place my take profit at this next resistance level right here. And you can see in this case, my risk to reward ratio is 1. That means I am risking 1% to make 1% back in return. Just think about it. If you are risking money, do you want to get back in return the same amount of money that you're risking? No, that is absolutely stupid, because you want to get back in return double the amount of money or even triple the amount of money that you are risking, so that you can actually make more money, right? Now, using back the same scenario, instead of entering for a buy right here, let's say you entered earlier, you got a sniper entry, you entered somewhere right around here when you start seeing price reverse from this support level. So once again, you place your stop loss below this support level, and then place your take profit and all the way up at the next key level right here. And you can see in this case, your risk to reward ratio has now become 4.56. So you are risking 1% to get back in return 4.5%. You are risking $1 to make $4.5. And I can honestly tell you that is much more worth it. So I will go ahead and take this trade. But I will never ever take a trade if the risk to reward ratio is less than 2. Okay, if it's less than 1:2, I will never take that trade. So if it's like 0.98, no go. Alright, if it's 1.68, no go. It has to be at least 2 for me to take that trade, because ultimately I want to get back in return twice or double the amount of money that I am risking. So the last concept that I want to cover for risk management is this thing called your maximum exposure. So this is more of an advanced topic to talk about. So maximum exposure is basically an overall amount of money that you are willing to have at risk at any one time. So you can only find out your maximum exposure after you have figured out your risk per trade. So make sure you figure out your risk per trade first and then figure out your maximum exposure. So maximum exposure is basically determined by the number of trades I can be in at any one point of time. So let me give you an example. Let's say once again, this man named Andrew, he decides to risk 1% per trade. Okay, he risks 1% per trade. And let's say his maximum exposure is 5%. This means that he can only be in 5 trades at any point of time. So how I got 5 is by taking 5% and divided by the risk per trade. So take the maximum exposure and divide by risk per trade. This shows me how many trades he can be in at any one time. So knowing this, Andrew, he cannot be taking 6 trades at the same time, alright? He should be only taking a maximum of 5 trades at any point of time. So yeah, for my maximum exposure, I like to keep it at 5%, and I will recommend you to keep it at 5% because you should never ever risk more than 5% on any single trade. So that's a very good, nice number to have. So like this video if you have learned something, and hit on that subscribe button for more free trading courses just like this one, and click on this video right here to find out the strategy that I use combined with this risk management strategy. It's gonna be insanely powerful. So click on this video to find out more, and remember, you're just one trade away. Mwah.